They did not ban you from trading silver. They did something smarter. They made it so expensive, so hostile, so dangerous for ordinary traders to stay in the game that most people will be forced out anyway. $52,000. That is the new price of survival in the paper-silver market. Not to own silver, not to take delivery, just to keep your position alive. And if you still think this is normal risk management, then you are looking at the biggest trap on the board and calling it policy. Silver on your screen says one number. Real silver around the world is telling a completely different story. That gap is not a glitch. That gap is the message. It tells you the paper market is under stress, the physical market is pulling away, and the people running the exchange are not trying to calm the market down. They are trying to control who is allowed to stay in it. Because this is what just happened. The cost of holding a silver futures position has been pushed up to nearly $52,000 per contract. In just weeks, the barrier to entry more than doubled. The game did not change by accident. The rules changed because pressure is rising, delivery demand is rising, and the system does not want broad participation when stress is building underneath the surface. That is the core of this entire story. Not silver going up, not volatility, not social media hype. The real story is that the gatekeepers just moved the fence while the crowd was already running toward the field. And when institutions do that in the middle of a move, it usually means one thing. They are not comfortable with what happens if the move continues. The official explanation sounds clean. Margin discipline, clearing risk, stability, the usual language. But the effect is what matters. Higher margins hit longs first. Higher margins squeeze smaller traders first. Higher margins force liquidations first. And when forced selling appears, price weakens, weak hands panic, and larger players get breathing room. That is how this mechanism works. Not in theory, in practice. And the timing is what makes this impossible to ignore. Delivery activity has surged in a month that was not supposed to be the center of attention. Demand for actual metal is showing up where complacency was supposed to live. A non-primary month suddenly starts behaving like a stress month. That is not routine. That is the market revealing urgency before it is ready to say it out loud. Look at the structure here. On one side, paper silver is flashing a price the exchanges want you to respect. On the other side, physical silver in major trading hubs is commanding materially higher prices. That spread should not exist at this scale if the market is healthy. A few dollars here or there, maybe. But when the difference starts becoming impossible to explain away, you are no longer looking at one market. You are looking at two markets fighting over who gets to define reality. And reality right now is this. People who want the metal are paying up. People who trust the screen are staring at a lower number and assuming that is the truth. That disconnect is where traps are born. Because the person who believes the lower number is often the one standing closest to the exit when the door suddenly gets narrower. The deeper issue is not price alone. It is confidence. For years, the paper market worked because most participants did not want the silver. They wanted exposure. They wanted leverage. They wanted a price move. The machine could function as long as almost nobody asked for the underlying asset at the same time. But the moment more traders start wanting the metal now instead of later, the machine begins to show its weak points. That is exactly why margin hikes matter so much here. They are not just financial settings on a screen. They are tools of crowd control. Raise them enough, and a huge portion of the market simply cannot participate. Raise them fast enough, and people do not even have time to adapt. They are forced to shrink, forced to sell, forced to step aside. The exchange calls it prudence. The trader on the wrong side calls it survival. The result is the same either way. And this is where the historical parallel becomes uncomfortable. When silver has threatened to escape the preferred narrative before, the rules changed. Not after the danger passed, during the danger. That is what makes these moments so revealing. Markets are supposedly free until the wrong people start winning too hard, or the wrong structure starts cracking too visibly. Then suddenly the language shifts from openness to protection. Protection for whom is the real question. Because ordinary traders are not the ones who designed a system drowning in paper claims. Ordinary traders are not the ones who benefit most from a drop triggered by forced liquidations. Ordinary traders are not the ones most capable of surviving repeated margin increases. Yet somehow the burden always lands in the same place. On the people with the least flexibility. On the people who believed the rules would stay consistent long enough for price discovery to actually happen. Now add another layer. Inventory has already been draining. Physical demand has already been persistent. Premiums in international markets are already signaling that people will pay more to get metal they can actually secure. If that environment were comfortable, the response would not be to aggressively raise the cost of staying long. A stable system does not need a kill switch every time stress starts showing up in the wrong corner. And yes, that is the right phrase here, kill switch. Because that is what this feels like when you strip the jargon away. A sudden increase in the capital required to hold a bullish position is not neutral in a market like this. It is designed to hit momentum, to hit optimism, to hit participation. It is designed to make the trade feel impossible for the average person, just as the underlying story gets more interesting. What makes this even more dangerous is the shift toward percentage-based margins. That sounds technical. It is not. It means the market can punish bullish traders automatically as price rises. The higher silver goes, the more cash traders must post just to maintain the same exposure. So even if you are right on direction, the structure can still choke you out. You can be correct on the thesis and still get removed from the game because the rules were built to demand more cash as the move strengthens. Think about how brutal that is. You identify a breakout, you survive the first leg, price rises, your position should be working. But instead of that strength bringing relief, it brings a larger capital burden. You need to feed the position just to keep it alive. That is not just volatility. That is a framework that mechanically leans against anyone trying to ride a powerful upside move without institutional scale. And while that happens in paper, something very different happens in physical. Physical metal does not issue margin calls. Physical metal does not care if the exchange changes formulas. Physical metal does not ask you for more cash because a committee got nervous overnight. That is why confidence starts migrating. Not because everybody suddenly becomes ideological, but because people eventually notice which side of the market can be redesigned against them and which side cannot. This is why the physical premiums matter so much. They are not just higher prices, they are votes. Every premium is a vote of no confidence in the neat little fiction that the screen price is the whole story. Every time someone pays materially above the paper quote, they are telling you they value certainty more than the promise of a cheaper claim. They are choosing possession over abstraction. And when enough people make that choice, the paper market loses moral authority before it loses pricing authority. That is how divorces happen in markets. First the trust cracks, then the spread widens, then the excuses start sounding weaker. Then everyone pretends they always saw it coming. The delivery data adds even more pressure to that picture, because it suggests urgency is moving closer, not fading away. A quiet month was supposed to be quiet. Instead, it started looking unusually active. That matters because stress does not announce itself with a trumpet. It leaks through anomalies. A strange delivery month, a sudden vault withdrawal, a stubborn premium, a lease rate that stops behaving normally. One warning sign can be ignored. A cluster of them starts becoming a pattern. And when lease rates jump, that pattern gets louder. Borrowing silver is supposed to be boring most of the time. When the cost spikes, it tells you somebody wants metal badly enough to pay up for access. Not someday. Now. Urgency always leaves fingerprints. So does shortage. Backwardation leaves fingerprints too. When the near-term metal starts looking more valuable than future delivery, the market is not whispering balance. It is shouting immediate demand. That is why the paper-to-physical structure becomes so unsettling. Too many claims built on too little underlying metal is manageable only while faith remains intact. The moment a larger fraction of participants want certainty instead of exposure, the system has a problem. Not because all claims rush for delivery at once. They do not need to. A small shift in preference can do enough damage when the ratio is already stretched. Imagine a theater that sold far more tickets than seats because management assumed most people would not show up. That strategy works until a hit performance arrives and attendance suddenly becomes real. At that point, the issue is not poor planning. It is structural fraud hiding behind convenience. The silver market has elements of that same logic. Too many promises, too much reliance on passivity, too much comfort built on the assumption that the crowd will stay satisfied with paper. But the crowd is changing. Not everyone, not all at once, but enough to matter. More people are asking harder questions. More people are watching the difference between screen quotes and street prices. More people are noticing that every time silver gets too lively, the system develops a fresh reason to make participation harder. That recognition matters because manipulation is strongest when it feels invisible. Once people start seeing the pattern, the narrative loses power even before the mechanism loses control. There is also a global layer here that should not be ignored. Supply chains are tighter. Export restrictions matter. Industrial demand does not wait politely for paper traders to settle their disputes. Silver is not just a monetary symbol, it is a real industrial input. It gets used, consumed, embedded, and dispersed. When deficits stack year after year, the market can pretend inventory solves everything until the day the drawdowns start feeling less like adjustment and more like depletion. That is the part many people underestimate. Silver is not a metal that simply sits there looking pretty in every case. A lot of it leaves investable circulation. It goes into panels, electronics, vehicles, systems, devices. It becomes harder to recover. It vanishes into the structure of the modern economy. So when deficits persist, the pressure does not vanish. It accumulates. And that brings us back to the trap itself. $52,000 is not just a number, it is a filter. It separates the market into those who can absorb arbitrary pressure and those who cannot. It tells you participation is now being rationed by capital tolerance rather than conviction. It tells you that being right is no longer enough. You also need enough cash to survive the exchange's attempts to break your timing, your confidence, and your position. This is how many traders lose in markets like this. Not because their thesis was wrong, but because the path was engineered to be punishing enough that they could not stay in the trade long enough for the thesis to matter. They get forced out. Price resets. The strong hands breathe again. The move later resumes. And the people who were right too early become the liquidity that saved those who were trapped. That is why paper silver has become such a brutal arena. The leverage looks attractive until the framework turns against you. Then every rule starts functioning like a pressure plate. Margin increases. Volatility spikes. Fear headlines multiply. Mainstream commentary calls it irrational. Retail confidence breaks. The exact people who should be asking why the system is acting this way are instead encouraged to conclude the trade itself was the problem. But step back and ask the bigger question. If everything were normal, why the urgency? Why the fast margin hikes? Why the delivery stress? Why the stubborn physical premiums? Why the visible strain between quoted price and real-world acquisition? Healthy markets do not need this many explanations at the same time. There are only a few paths from here. 1. Paper prices are eventually forced higher to reconnect with physical demand. 2. The split between paper and physical becomes more permanent and more obvious. Either way, confidence in pure paper claims gets weaker, not stronger. That is the key point. This is not just a debate over valuation, it is a debate over credibility. Now be honest with yourself. If you were seeing these signals in any other market, would you call it stable? If you saw rising delivery urgency, a widening spread between screen price and real-world price, aggressive rule changes and unusual borrowing costs, would you describe that as normal? Or would you say the market is under pressure and the institutions running it are buying time? Because that is what this feels like. Time buying. Not resolution, not clarity, not confidence, just time. And when a system starts buying time, your job is not to become emotional. Your job is to become precise. To understand the difference between the game they want you to play and the reality they are trying to manage. The expensive lesson here is that leverage in a manipulated structure is a privilege until it becomes a weapon pointed back at the participant. So no, the real issue is not whether silver can move violently. It can. The real issue is whether you understand what kind of battlefield you are standing on. Paper silver is not just a trade. It is a rules-based environment where the rules themselves can be changed in the middle of the move. Physical silver is not magic, and it is not risk-free, but it does not live under the same trapdoor. That is why so many people are rethinking the difference between exposure and ownership. Exposure can be repriced. Ownership can be patient. Exposure can be margined out of existence. Ownership can sit through noise. Exposure depends on the integrity of the system. Ownership depends far more on your own discipline. Could silver still get hit hard from here? Absolutely. Could more scare tactics appear? Of course. Could the authorities keep using every available tool to exhaust participants? Yes. Anyone pretending this will be easy is selling fantasy. But difficulty is not the same as weakness. In fact, sometimes the most revealing thing about a market is how aggressively it has to be managed to keep participants from discovering what it might do on its own. That is the tell here. Not strength, not confidence. Management. And if that is true, then the $52,000 hurdle is not proof the system is healthy. It is proof the system is nervous. It is proof somebody does not want broad, leveraged participation in a market where physical reality is already straining against paper control. It is proof the trap has been set exactly where ordinary traders are most vulnerable. So here is the decision point. Are you going to keep pretending the rules are neutral when they keep changing against the same side? Are you going to trust a quoted price more than the behavior of the real market around it? Are you going to stand in a structure built to liquidate you and call that freedom? Or are you going to recognize what happened for what it is? A warning, a filter, a confession disguised as policy. Because that is what this looks like now. Not a calm market managing risk, a pressured market defending its pressure points. Drop your view in the comments. Do you think this ends with paper catching up to physical, or with paper losing credibility altogether? And one more question. If you had to choose only one, would you trust the screen price or the physical premium? If this opened your eyes, subscribe and stay close. The biggest moves always start with signals most people dismiss while they still look technical. This one just stopped looking technical. It started looking personal.